Welcome back. Well, the green continues as far as the frontline index is concerned, but I think it's a broader market where the pain is quite evident. The small cap index continues to reel under pressure, and if you look at the advance decline ratio, it's not suggesting a very healthy sign because there is a bit of a pressure as far as the broader market is concerned as well. Though it's off the lowest point of the trading session, but individual names, they are taking quite a bit of beating at this point of time. In terms of the individual names which are coming under pressure, it's of course Keynes Technology, which is down almost 10% now. India Cements has recovered from the day's low but still under pressure, and then Century Textiles, India Mart, these are some of the other names which are in the red right now. Chakri Lokapriya also joins us on the show right now. Chakri, hi, good to be speaking with you. Before I get a market sense from you, why not let's discuss the cement pack, because there was a sign of recovery when the pricing power had returned. There was the chatter that consolidation is perhaps over, real estate was doing quite well, but none of it is actually showing in the numbers. What to do with the cement pack now?
I think cement pack is largely become a two-company race between Ultratech on one side and ACC and Ambuja on the other hand. These companies are pan-India players today. They have the volume presence, they have the distributor reach, and therefore they're less so interested in the pricing, getting the pricing power back. So in a market share game, the other players will continue to suffer. And it's not particularly a very strong economy for the pricing to pick up either. So against this backdrop, if we have to buy cement, then it would be Ultratech, ACC, and Ambuja, market leaders, and there at least the volumes will help the companies.
Okay. The commentary from Dalmia Cement was not bad. While the numbers may be bad, the commentary actually was not bad. Mark the stock there, which is that the Dalmia Cement days low versus the current level. These numbers are meaningless. Why? Because you have to look it forward. Cement is a commodity where you buy the bad news, you sell the good news. Intraday graph, please. Now with that kind of a positioning, the stock actually has bounced back. When I say that kind of a positioning, in terms of the market cap. And Naresh, typically when stocks, they stop falling on bad news, they bottom out. Stops when they start rising on good news, they peak out. Dixon, the numbers were not that bad, but the stock broke. Dalmia Cement numbers were not great, but the stock has bottomed out. Reliance numbers were not that great, but the stock started flaring high. HDFC Bank numbers in line with a marginal beat. Today the market is reacting. So can one say, Naresh, that cement maybe is reaching that point where it has started to bottom out? Naresh.
So if you look at all those cases, it is the preceding price action for the last 3 years. So if you go to Dalmia Bharat, the stock was at 1718.
Oops. Just when you thought we were cementing things, the correction has broke. Okay, Kunal, that same logic. Has cement bottomed out?
It seems like, because over the last few weeks, we've seen many of the cement stocks, ACC, Ambuja, showing signs of strength. Ultratech Cement, I think, has been a class apart over the last 2-3 years. The stock breaking past first initially about the 10,000 mark for Ultratech Cement, then moving up higher by a margin of another 20%, 30% further in mid 2024. And right now, when the stock is going through that correction, that 10,000 mark is acting as a major support point. So there has been inherent strength which has actually been built up into the cement counters, especially with the resilience these stocks had shown for a good part of 2024 and the attractive risk reward which these stocks are offering. I think add to that, a very key characteristic of the cement counters is that these are neither a very high beta sectors, they are nor a very low beta sector. So they come back into their own sweet trend irrespective of the major market moves, and whenever that happens, we see these stocks moving up by a margin of good 15% broadly on a positional basis. So I think we are now into that phase where potentially many of the cement stocks are coming back into a breakout mode, the likes of ACC, Ambuja specifically on the short-term charts, and I think with strength coming back to large cap names like maybe Ultratech Cement, I think it could just add to a lot of positivity for the cement sector.
So what is the better strategy? Buy the stocks which have fallen the most, go and buy Zomato, go and buy Dixon, go and buy PSUs, because they were the leaders, they've fallen. Or go and buy stocks which have not participated, a Reliance, an HDFC Bank, a Grasim, to some extent L&T, Bajaj Finance, because if the leadership changes, the stocks in hibernation will come back. What is the better approach?
So, it's a classical question. It's a classical question, and we keep on asking this question in the markets as well. But the answer to that depends on which phase we are expecting the markets to move towards. For example, Now, if someone is a very high risk individual, for him buying these stocks, especially with a drop of 30%, for example, the likes of Zomato, Dixon, maybe if I can add to the list of stocks, Trent, Indian Hotel, etc. When you see 30% to 40% cut into these stocks, somewhere down the line these stocks would become deeply oversold. And when that happens at a point when the markets or the benchmark indices are getting into a point of major support, the risk reward is absolutely in your favor to go for a contra buy into many of these names. I'm not saying go all hog into these stocks, but maybe buy into 50% of your expected quantity, which you're looking to deploy into these stocks on an average basis. The other part of the question is also very true, because eventually what could happen is that the markets would find new sectors and new large cap names which have been erstwhile underperforming. They could start to pick up pace. For example, over here in this case, look at Kotak Bank. I think that stock has come back into a slight bit of a breakout mode. The tempo for Kotak Bank has changed. Earlier the stock was a sell on rallies. Now we are seeing mild dips for the stock being bought into. So that I believe is a change of characteristic for the stock. And I think if similar trends is what we can expect for the likes of Reliance and HDFC Bank, all we may probably expect on a positive front is new textures for markets emerging going forward.
Right. Chakri, let me come to you and ask you about the entire EMS space. How is that looking to you, given the fact that there was a lot of favor for this particular domain, but over the last few months, it's not been that great. Today is not great in particular also for most of these players, especially after Dixon Tech's numbers yesterday. What's your take on this one? How should one look at the space?
Two or three things. One is, of course, in the last 1 year or so, their export revenue has kind of slowed down. Second, the electronics generally has slowed down. And third, with semiconductors and other new avenues opening up, all these guys again want to spend capex on each one of these companies. So against an environment where electronic sales are down anywhere between 30-40%, and on top of that, there's a capex. Of course, capex is good for future growth, but current growth is slowing down. You look at all these companies, Keynes, Dixon, these are all trades at very high multiples, and therefore they need to continue to deliver very high growth rates of revenue, which they are failing. And therefore, I think, one has to wait. We will wait by the sidelines until some amount of acceleration of top line comes back.
Right, so that's about the EMS space. And what about the defense space? Because today also, if you look at it, some of them are not having a great day in trade today. Do you think this is the jitters just ahead of the election, or I beg your pardon, just ahead of the union budget, Chakri?
You think, we think that the union budget largely is unlikely to see any, big announcements, largely in defense or in railways. If they continue to improve the capex spend growth rates, that would be welcome. But I doubt there is the fiscal capability in the bank, and as long as they don't do something untoward like increasing taxes, I think that will be decent enough for the markets. What is needed is a lower interest rate, some kind of policies which will invigorate growth other than talking about taxes.
Apart from taxes as well, there's a lot to discuss in the union budget. But just in the last few minutes, there is a bit of a reaction on some of these smaller financial names. And I'm talking about Five-Star Business, which is up. PNB Housing came out with a good set of number, all-round beat. That's getting rewarded by the street. You also have SBFC Finance, which is doing well. Jana Small Finance Bank, of course, came out with its earnings and got, rewarded by the street as well with that 18% move coming in. But Chakri, do you think that worst of that MFI pain is behind us and factored in the stock prices, and it's time to start accumulating again?
The MFI seems to have bottoming out rather. And so the next is, therefore the loan loss provisions, etc. will improve in the coming quarter if it has bottomed out. And I guess what is all needed for across this whole sector is lower interest rates. And, that hopefully RBI cuts rates sooner rather than later. That is very important for a reacceleration of the top line for all these companies. And until that happens, I think valuations can be okay, but if growth is not evident, valuations will continue to languish. Stock prices will continue to languish.
What's the take on consumption, Chakri, right now? Do you really anticipate that the government has enough firepower to boost consumption in the union budget?
Lever is a good example of the lack of consumer spending. This is a company which is a market leader, and its overall volume is growing between 1% to 3%, depending on the various categories that it sells. And, it's not able to raise prices beyond its raw material costs, and there is no pricing power. That shows that not only there is there is competition, even despite being a market leader, is not able to face competition. So against this whole backdrop, I think, what can the government do really? I think what is needed is, other than the usual every year, is something innovative which invigorates demand at the bottom of the across various points in cycle. But we'll have to wait and watch.
All right, so that's the take coming in the consumption names. Chakri, I wanted to also get your take coming in on the IT sector, especially the defensive pack, IT and pharma. Out of these two, which one would you bet on, given the fact that you have a change in the regime over there in the United States, a lot of hopes building in, at least for the IT sector, and the pharma also, you saw a lot of big flip for this one in the month of October on the fact that there could be some inroads or headway when you talk about the Biosecure Act. But among these two, if you had to bet on, which one it would be?
I guess that, both IT and pharma will do well. Primarily because of a better US outlook. In the case of IT, it's more readily going to happen, likely to happen simply because, all corporates are reporting strong numbers in the US. Their IT budgets are increasing. Discretionary order book is firming up. And the valuations for all these companies is very reasonable. So I think, IT does well. And in the case of pharma, Biden's government, the previous government, was actually quite negative on big pharma, and it was supporting the pharmacy benefit managers in the US, which kind of put lots of pressure. And, at least Trump doesn't have that kind of an agenda, a socialist agenda. So in that net, the pharma environment in the US is more positive under Trump, and therefore, the export segment of Indian pharma can also do better.
If you like this video, then like, share and subscribe to ET Now.